Good morning to everyone, especially core mining shareholders. If anybody is a core mining shareholder, congratulations this morning. Your day has come.
Test 1, 2, 3, 4.
Yep. Good morning, Rick. How are you?
Good. Fine. I wrestled with the technology a little bit, which is what one would expect of a 70-year-old. How are you?
Good. Yeah, it's interesting that you mentioned you're a 70-year-old again, because I want to use some of your age and your wisdom and your experience in this conversation. I listen to a lot of your interviews. I probably listen to at least one a month, and it's always enlightening. It's always insightful, but a lot of the same questions get recycled. So I wanted to ask some novel questions, some new stuff, and see if I can extract some new content from your 70-year-old brain. um I have this concept of the bull market adjustment trade, and it can work in any sector of the stock market. But in junior mining, my concept is essentially that something happens on the corporate level, either a new result with the drill, new investor comes in, that was completely unexpected, a positive, surprise to the market, something of that nature, something that was unforeseen and potentially wildly positive for the potential value of the company. And this trade starts to work, right? People read the news, the market opens, speculators start to pile in, and then the news filters out across Vancouver and Canada and across the world. And more speculators appreciate the potential of the news, and the stock appreciates further and further over the coming days and weeks. And eventually it will always reach a point where the valuation is fully or excessively valued, and then something else starts to happen. But that virtuous cycle of the first few weeks or month of the bull market adjustment trade is a very interesting concept for me. I was wondering if you could rack your brain and think back in your memory, maybe even back to the 80s and 90s, of a particularly powerful sort of a bull market adjustment trade that you participated in.
Yeah, I should start with a interesting observation. In a really bad market, the opportunities are the greatest because you can have an extraordinarily positive development and the stock sells off. And you have the ability, armed with the facts, to buy more shares than you otherwise would. Remember that in the short term, markets are voting machines. They measure popularity. In the long term, markets are weighing machines. And the best markets of all are the terrible markets, where great news is met by selling. But to get back to your question, my favorite memory of the type that you described was as a consequence of being a very early shareholder of Franco-Nevada, and being then indirectly a royalty holder on the Barrick lands in northwest Nevada, in particular Goldstrike. There was a press release, and I forget the year, but it would have been 85, 86, of a drill hole at Goldstrike that was aptly known as the Screamer Hole, named because of a red-tailed hawk. But the Screamer Hole, if my memory serves me correctly, was almost 300 meters, 1,000 feet, of 30-gram or 1-ounce gold. It was then, and is now, the most extraordinary hole that I ever saw. I had to reread the release once. And I remember calling up our Canadian trader, Barrick was the operator, and saying, "Barrick, I want you to buy." And I remember the trader saying, "Limit?" I said, "None." "Quantity?" I said, "No limit." "Buy." I've never had a circumstance like that before in my life. And I had the extraordinary good fortune to see the drill hole as it was released and act before the competition was able to react. And mercifully, I'd been in markets long enough to know that that was a once-a-decade event. And I remember buying, I think the stock closed the day 30% higher than it had opened. The next day, it closed sort of 100% higher than it had opened before the announcement. It was a truly, truly miraculous discovery. And over time, a couple things happened. People who hadn't been paying attention to the market that day paid attention. People who didn't understand the context of the whole, that is, people who hadn't studied Goldstrike to the extent that I had and didn't understand the importance of the data, came to understand the importance of the data. The whole fee-generating machine of Bay Street and Wall Street swung into action, distributing research so that they could earn commissions and fees. But it very much unfolded in the manner that you describe, and that was the most dramatic instance of that I recall.
And how long did that sort of trade, the speculative phase of that trade last?
Probably 3 months. And I say 3 months. In truth, it lasted for 6 years. When I say 3 months, it was 3 months because it took 3 months to have confirming holes drilled and the initial news put into context, and overcome any lingering doubts that the hole had been either intentionally or accidentally oriented down the structure, which is to say that it wasn't a true width. Mm-hmm. When the hole was scissored, and that is to say, drilled with a different orientation, and that different orientation confirmed the results that had been obtained by geophysics about the possible aerial extent of the ore body. The market kept on reacting as more and more data came in, verifying to a higher and higher degree of certainty the initial data. The market kept on traveling.
But
There it went from a sort of a 250 million market cap to a $10 billion market cap as a consequence of that.
yeah. So what was that result again? How many grams per ton over how many meters?
If my memory serves me well, it was something around 300 meters. So 1,000 feet of 30 gram or 1 ounce gold.
Wow.
Yeah, it was.
Wow.
It was a pretty spectacular hole. Now, there were some spectacular drill releases too later from Indonesia, from an issuer called Briex. The problem is they were false.
Did they really report 300 meters of 30 grams?
No, they didn't report anything like that, but they recorded a couple of 300 or 400 meter of 3 grams. Importantly, beginning on surface, what they were trying to describe was a 3 gram open pit. It was fraud.
I don't know what I would do if I saw a news release where a company reported a whole 300 meters of 30 grams per ton gold with continuity all throughout the 300 meters. That would be shocking, to say the least.
Well, I was very lucky in that I had read in 1970 the wonderful paper, The Alignment of Mineral Deposits in Northeast Nevada, which really was the prophecy of the Carlin trend. And because I was a shareholder in Franklin, Nevada, I paid real attention to the test of the Goldstrike sulfides. It was always theorized that these wonderful oxide deposits in the Carlin trend had sulfide roots. There had to be a fluid mechanism for the gold to come up into the sediments and the carbonates. And we all thought, given the incredible aerial extent of the oxides, the heap leach material, that there had to be some sulfide feeders, and these sulfide feeders could be pretty interesting. The geophysics that Barrick did suggested that there were large mineralized or potentially mineralized feeder zones, and that there were large magmatic intrusions into this sedimentary environment. So my mind was already acclimated to what good data could mean. And then when the drill hole came in with that kind of data, I thought a really good outcome would be 30 or 40 meters of 10-gram material.
Mm-hmm.
Uh,
Yeah.
300 meters of 30-gram material was something I was completely unprepared for, except that I understood something about the nature of the material. Uh, I understood something about the nature of the target.
Right. Yeah. Although with 300 meters of 30 grams, I'm not sure you need to understand anything. I think
Well,
that would, yeah.
if you look a little north of where they went to Midas, where they uh, characteristically mined 60 or 70-gram material, that was a much narrower structure. And had you drilled accidentally in orientation along the vein, you would have got illusory widths, because you weren't drilling across the vein. There are occasions where people accidentally or on purpose orient a drill hole in a way that doesn't give you a true width, where they drill right down the throat of the vein. In this particular case, there was a fairly well-known target based on the geometry of the surface and also on geophysics that sort of prepared people who were paying attention to the hole to what the data might mean.
Yeah, that's important. So context is key. And I want to follow up with you on that topic. But first, according to the internet, it was 1987, and um, gold was about 450 an ounce in 1987.
Yeah.
So this was a company maker for Barrick. The Goldstrike, Discovery absolutely made that company what it is today, or maybe you could say, what it was previously. I'm not sure what it is today. But it was a company. It was a company maker for sure. That might be the greatest gold, discovery in modern history, or maybe in the history of the world. 44 million ounces mined since 1987.
Yeah, I mean, I'm not familiar with another, in effect, grassroots discovery of that order of magnitude.
Yeah, that's tremendous. So next question is easy. Sometimes it's easy to buy, or it's easier to know when to pull the trigger and buy. Like you said, you knew as soon as you read the news release, you were going to buy, and you're going to buy as much as you possibly could afford to buy. When do you sell? So the bull market adjustment trade was playing out for a few months. You were seeing your account equity rise on a regular basis, making tons of money in this trade. When did you take profits?
Well, on Franklin, Nevada, never. I held it until Newmont took it over, which means I gave back a fair bit of the gain, but in absolute terms, not in percentage terms. Um, uh, when Barrick got, in effect, short gold, when there was a $2 billion contingent liability on Barrick's book, financing their expansion by, in effect, being short gold. And I looked at the downside leverage in Barrick in a gold bull market. I began selling fairly aggressively. I'm not one that pays particular attention myself to research reports and stuff like that. What I try to do myself is I try to construct very rough, understanding that they're very rough valuation models. And before I worry too much about the price of something, I try to establish what I think the value is or might be. So in the case of Barrick, they were doing things with the balance sheet that, to me, presented the opportunity for really, truly systemic risk. And I had to penalize my net asset value calculation with what would be the outcome for them of a gold bull market.
Yeah, Barrick was in the penalty box for a while. This company has had a few cycles where it went into the investor penalty box, and I think throughout the late 90s and early 2000s, it definitely went into the penalty box and actually became a big enemy of the gold bugs because they were doing all that hedging, right?
Yeah, I probably the first $600 million worth of hedging I thought was a good idea. There was a period in time when pretty obviously uh, there was too much market um, anticipation of a higher gold price. And you could sell gold forward 10 years forward in a very high interest rate environment and use the money that you got from the forward sale to reduce your cost of capital. When Barrick was using that money, uh, we were in those days in a 12% interest rate environment, and Barrick could borrow money against gold at 3%. When they could uh, utilize that money to borrow gold at 3% to fund the capital cost to put gold mines into production that would generate substantial margins at the price they'd sold gold forward for. In other words, when they used the gold as a financing mechanism to add capacity that would in and of itself service the debt, where they didn't have to service the debt from the existing production, I liked it. What happened with Barrick is that so many of their earnings began to come from forward sales that the size of the obligation began to exceed their ability to service it from the proceeds that they were getting from the forward sale. In other words, when it became a financing strategy, then I began to get nervous.
Okay, fair enough. Um, so I mean, I take it to mean that you held it for a few years and only then.
Oh, yeah.
Okay.
Yeah. Yeah. I think that's important in a discussion like this. You may know or you may not know, I've graded tens of thousands of portfolios for free over 30 years. I do it for anybody who wants. While I'm at it, I'll just make it easy. RuleInvestmentMedia.com, list your natural resource stocks, I'll rank them. The beauty of having a 30-year database with tens of thousands of investors is you learn over time what investors do right and what investors do wrong. And I would suggest that there are two really common flaws. The first is that investors chase what's hot. When uranium is at $20 a pound and has to go up, nobody wants to know about it. When it's gone up to 80, that price action justifies their sense of the narrative. But the fact that the stuff has gone up fourfold takes most of the value out of the narrative. So most investors are anti-contrarian. The second thing is that most investors strategically are right, but tactically they're wrong. What that means is, as an example, somebody believes that we're going to have a copper shortage in 5 or 6 or 7 years, which we are. And that the logical consequence of that, X recession, is that the copper price is going to go up, which is true. If they have a 5-year strategy, often that same investor has trauma holding stock over a long weekend. A 5-year strategy and 3-month tactics aren't concurrent. It doesn't work. To make the kind of money that I made on Franco-Nevada, or the kind of money I made on Altius, or the kind of money I made on Paladin, you have to own the stock for 5 years or 6 years or 7 years. I am both an investor and speculator personally. But the money that I now invest carefully, I made speculating wildly. And one of the secrets to my success as a speculator has been time. When we looked at 40 years of speculation, my speculation, and we saw the few trades that really, really worked, the 10 baggers, the 20 baggers, the 30 baggers, they had a couple things in common. 4 things in common, really. The first is that the average holding period for a multi-bagger, a 10-bagger or better, was 5 years. most speculators can't conceive of holding a stock for 5 years. The second, which is more disturbing, is that in almost every case during the period of time I held the stock, the share price declined by 50% or more. A stock would go from $1 to $4, and then it would go from $4 to $2, and then it would go from $2 to $8, and then it would go from $8 to $5, and then it would go from $5 to $10. Beginning of the exercise was $1, end of the exercise it was $5, but once or twice during that period of time, the stock would fall by 50%. The only way that you have the courage to hold or add more during a decline is if you temper your knowledge of the share price with an opinion as to the share's value. That's the only way.
Yeah, and then that leads to a whole nother conversation about value, which actually we've delved into a little bit before. But I kind of want to I want to delve into something else here this morning, because I don't know about you, but my sense is in 2025, the flow of information out there, and especially in markets, is on warp speed. We're getting more information constantly. It never ends. And my experience is 99% of it is noise.
Yep.
And not necessarily helpful, and actually potentially negative for an an investment process, and for making profitable choices in financial markets. What say you on this topic?
Absolutely agree. Absolutely agree. I've seen companies that issued press releases because coverage on them had been picked up by, some podcast host whose, experience around gold was that he or she had once bought some jewelry. You need to be able to separate the wheat from the chaff. It's interesting that, people read all of this stuff about these companies, but if you ask them if they read the quarterly report, or if you read the company's insider filings, purchases of sales or sales of insiders, if you ask them if you read a summary of the credit agreement, if you ask them about anything that actually has anything to do with the fundamental affairs of the company, they say, oh no, I didn't do that. In fact, they rely for information on a stockbroker who earns a fee, who probably hasn't read the annual report either. I ask people who pay attention at the Rule Classroom to what I do to limit the number of speculations in their portfolio to the number of hours they're willing to work per month on their portfolio. If you're willing to work 10 hours a month, and when I say work, I don't mean participate in the discussion groups at the Rule Classroom, but rather read 10Ks, read 10Qs, read quarterlies, read resource statements. If you're not willing to spend an hour a month on a company, you shouldn't own it.
There's a famous quote from Warren Buffett that says basically, if an investor is upset when a stock they own drops 10%, it means they think the market knows more than they do.
Yep.
That's a powerful statement, but sometimes the market does know more than I do. So how do you tell between this 20% drop is somebody who just caught wind of something that I don't have access to, some knowledge about some change in the company, versus this is the market just giving me a tremendous opportunity to actually buy?
Well, first of all, if you're a speculator, you're going to lose money more times than you make money. But the wonderful arithmetic of speculation is that if you enjoy a 10-bagger, that amortizes a whole bunch of 20% losses. What I'm trying to say is the process isn't perfect, and you will fail. And you won't ultimately fail, but you'll make some bad decisions. That's going to happen. If you're not prepared to accept that, you need to do something sensible for a living. Go deliver mail or something like that. More often than not, markets are emotional. The wonderful Buffett quote, in the near term, markets are voting machines. In the long term, markets are weighing machines. The assumption that in the near term markets are rational means that you agree with the way people vote. Certainly not something that troubles me. So yes, there will be occasions when somebody has access to information that you don't, or a lot of the market has access to information that you don't. To the extent that you aren't a practitioner of gathering information, probably you should do something other than speculating. There will be circumstances where preparation meets opportunity, which is to say you are Rick Rule and you receive information because you're looking for information that a company that you're aware of has drilled a project that you're aware of because you paid attention to the geophysics and because you paid attention to the theory of emplacement in sediments and carbonate replacement, that that a drill hole means you have to buy.
I want to talk about the Rule Symposium and the virtual boot camp, but first, I want to get another story from you because I think this could be very entertaining, potentially. I don't know. We'll see what comes out of your mouth. We talked about a good story. We talked about the bull market adjustment trade in Barrick, the Screamer hole, 1987, 300 meters of 30 grams. Let's take the other end of that pendulum. So a very unsavory memory, one that you don't really relish, where maybe you read a news release or you talked to a CEO and you got some powerful insights. You thought, oh, I got an edge here. I got to buy this stock.
Right.
You bought the stock and the story was nothing like it was in the news release or nothing like your conversation with the CEO, and you end up losing money.
Yeah, yeah. There's one of those that's great. I mean, I laugh now because 30 years has passed. There was a Canadian income trust called Heating Oil Partners. For your listeners who don't remember the income trusts, it used to be in Canada that you could structure businesses as publicly traded trusts where the income from the organization wasn't taxed at the organization level, but was passed through to shareholders and taxed to you. This was a very efficient way of distributing surplus cash from slow-growing businesses. And there's no business in the world maybe as slow-growing as retail distribution of heating oil. At any rate, Heating Oil Partners was a business that distributed home heating oil in Atlantic Canada and in the northeastern U.S. And they had a fairly challenged balance sheet. They had very high distributions, but I looked at the balance sheet and I thought if worse came to worse, I could finance them. I could finance them personally. It didn't occur to me that the management team perhaps had more to win in terms of increasing their percentage ownership if they went into bankruptcy, as opposed to working out their existing circumstances. So by either assigning the management team too much credit for intelligence or not enough fear of nefarious activity, I owned a company that had a balance sheet that I wouldn't otherwise have owned because I believed that a rational person acting in the interest of all shareholders could repair the damage that was done to the balance sheet. The consequence of that is that I suffered 100% loss.
So what was the error, the blunder that you made? It was an assumption that they would act in your interest?
It was an assumption that they would act rationally and in my interest. One should have said, if these guys were rational actors, they wouldn't be in this circumstance. And by the way, that's something I've adopted ever since. I am reasonably good at understanding the interplay between balance sheets and income statements. What I am at my heart is a credit analyst. I assume now when somebody comes to my attention as a credit analyst in a negative way, unless there is a transaction to refinance the credit myself that I'm involved in, that if they were stupid enough to get themselves in that situation, they may be stupid enough that they can't get themselves out of the situation. So even though the liabilities rather relative to the assets are workable, I don't assume that the management team that got themselves into that problem can get themselves out of that problem.
You just opened up an interesting topic there, because you can actually learn a lot from the balance sheet and from the share structure of a company just by looking at those two items. There's a lot of bodies buried there.
Yep, absolutely.
And probably, like you said, like somebody you want to invest alongside of is probably not going to have a broken share structure with a lot of cheap warrants out and very little cash and debt on their balance sheet, right?
Well, let's go further than that. Yeah, let's go a lot further than that. Many of your audience won't know what the Pareto principle is. The Pareto principle is a social science dictum around the 80-20 principle. The 80-20 principle, many people know, suggests that 20% of the population does 80% of the work in any given activity. For our purposes as investors, though, we need a broader understanding. First of all, performance is a bell-shaped curve. So while it's broadly speaking true that 20% of the population generates 80% of the 80% of the positive utility in any task, there is a different 20% of the population that generates 80% of the aggravation. So your first job is to hang out with the good lip, the good 20, not the bad 20, and not even with the middle. The second thing is that it turns out that these performance dispersal curves conformably align. So if you take the good lip or the bad lip, the 20 that do the good or the bad, and you run that population through the same performance dispersal curve, their performance conformably aligns, which is a fancy way of saying that 20% of the 20 do 80% of the 80, or 4% of the population generates 64 or 65% of the positive utility. Because I've been in the mining business for so long, I've learned that the performance dispersal curve conforms again. What that means is that 20% of the 20, or 0.8% of the population, generates 40% of the utility. So most of the time, you don't have to screw around with the great unwashed. Most of the time, you don't have to read press releases. Most of the time, you don't have to pay attention to shareholders, shareholders' letters or share structure. Most of the time, if you hang out with the best of the best, if you hang out with Bob Quarterman, if you hang out with Ross Beaty, if you hang out with Lucas Lundin, if you hang out with Robert Friedland, most of the time, you don't have to worry about too much else. If for some reason there is an asset that attracts you, or if there is an entrepreneur who is unknown to the market but known to you, then yes, you have to do a much, much, much stricter form of due diligence and then information monitoring.
Speaking of Ross Beaty, he is very well respected. Obviously, has a tremendous track record, and he's generated a lot of wealth over the years. But his company has continued to have a challenging time. Did you see the results out last night, Rick?
I did.
What's your take on Equinox?
I have two takes. The first is that they badly miscalculated the financial impact of the hard rock deposit. The second is that in financing hard rock, they deferred sustaining capital investments elsewhere in their portfolio. They have had to this year refinance their balance sheet, complete hard rock, and it's pretty obvious that although they have achieved economic completion, they have not achieved nameplate capacity there, while simultaneously curing sin elsewhere in their portfolio. The time has come, I think, at Equinox, and Ross does this in his companies, where you sell off the third-tier assets. So they need to sell off Los Feliz. This is a good market to sell assets in. Perhaps they need to sell off the California assets, maybe not Mesquite, but probably Castle Mountain, and focus on the core asset. The other thing is that you have in Ross Beaty a guy who's actually even older than I am, as hard as that may be to believe. He's a very, very bright guy. He works very, very, very hard. He, in the period July, August, and September, actually retires. When it starts raining again and he can't kayak and tend bees, he comes back to work. So you don't have 100% of Ross Beaty. The other lesson, however, is that at Equinox, you do have an in-place owner, which is to say Ross Beaty. You have adult supervision. I have never had a Ross Beaty company. Well, let me rephrase it differently. I have been invested with Ross Beaty 14 times in 40 years. 12 of those times I've had 10 baggers. In each case, I suffered through. In each case, every goddamn case, I went through a circumstance similar to the circumstance I'm going through in Equinox, which is to say a market failure and an economic failure. In every case, I have had to suck it up, look at the information, and decide whether or not the difficulty expressed by the market was permanent or transitory, and make a decision to buy, sell, or hold.
Very good. Yeah, that's a powerful stat you just shared. 12 of 14, 10 baggers. But
And by the way, that's wrong. It's 12 of 15 because I forgot to include Equinox.
I mean, 12 of 15, 10 baggers is such an extraordinary number. I'm speechless. Yeah, that's extraordinary. West Red Lake Gold. They're going to be attending your Rule Symposium in Boca Raton, Florida in a couple of months. I want you to tell us about the Rule Symposium, but first, did you look at the West Red Lake Gold bulk sample result?
I like the sample result. What I don't like is the apparent decision to return the thing to production without a brand new full feasibility study. These guys are smart guys. The guy behind it, Frank Justra, is pretty good adult supervision. I've known him for 40 years. But I have some experience in the Abitibi. I have some experience with ore bodies that are supposed to be consistent enough that you haven't drilled off all the material. So I have to say I'm afraid here. I own it. Mercifully, Frank delivered such spectacular share price performance in Red Lake that I was able to sell enough of my stock that I got the rest for free. I often do that when I think stocks get ahead of themselves. If I bought them for a reason, the reason is speculative. In the case of West Red Lake, they didn't buy, rather they sold the asset, partially from me as a creditor, and they got it so cheaply, and it fit in so well with their other assets in the Abitibi that I was fairly certain that they would be able to affect some synergies, and over time the share price would go up. Rather than that occurring, the anticipation that they would be successful caused the share price to triple. So I got paid before the events that I was counting on took place. When that happens, when I get paid for free, I always take money off the table. So at West Red Lake, I took money off the table. I'm at what I call now the point of no concern. That differentiates it from the point of no return. In other words, I was able to recoup all of my capital before enough time had passed that the valuation in the company justified the price.
I think you gave a very good lesson there for people who are paying attention. If somebody has a question for Rick, we'll take one from the audience who asked to speak, and I'll call on you, and I'll keep asking you about a few companies that are attending your conference, and then I would like you to tell us about the conference in Florida, which I will be attending. I heard through the grapevine that you became a shareholder of Banyan Gold. Why did you decide to become a shareholder of Banyan Gold?
Took me a long time to warm up to Banyan Gold. A long time. And what happened is that the stock sold off substantially as a consequence of the bankruptcy of Victoria Gold. And when the whole Yukon went on sale, I had always liked the young woman who runs Banyan Gold. I hold her in very high regard. And she was always very forthcoming with information with me, including when the information was bad, which is to say, when it conflicted with, um, you know, when the information was deleterious. She was always very forthcoming with good and bad information. So I liked her, and I wanted to get involved because the deposit's big. What I didn't like was the lack of a high grade starter pit. I didn't like the return on capital employed with the project. So I was looking for an entry point, but I was looking for an entry point that was lower than the market. When the Victoria debacle happened, that company's share price fell by 65%. What happened was that my estimates of its value were higher by a substantial margin than the share price. So then I was able to bite.
Okay. Paul, yeah, you're off mute. That was the background noise. Paul, you have a question for Rick?
Okay, sorry about that. Yeah, I was just wondering about just in regards to why an independent study would be done in regards to say like with Hercules recently with that. Is that like, they haven't really had much in the way of results, and then they have an independent study. I was just wondering when that gets done and what that means.
Yeah, I like independent studies. What matters to me is who does the independent study, and not just the company. Let's say, as an example, that SRK is going to do an independent study. They got 1,000 engineers. I want the engineers that do the study to be the A team. In the case of Hercules, I want them to understand both epithermal gold, which is to say proximal mineralization, and porphyries. And hopefully, I want that experience to be in tertiary volcanics and accreted terrain. If I get that, I pay real attention, not because I think that the independent study is going to be definitive, but because it's the best information I have available to me, and it allows me to make better probabilistic decisions going forward. If the information comes from a brokerage firm, as an example, whose interest is in generating commissions from a higher share price or moving off inside positions that the people in the brokerage house have, I have a lot less interest in it. I hope that helps.
Yeah, I think in the case of Hercules, it was important because this project is pretty complicated and they needed some big brains to study it in detail. And so that's why an interested party paid for this study to be done.
It is always useful to have high quality second or third opinions.
Yeah.
Always important. I've had 15 cases in my life where I've looked at a company and I thought I had it exactly right, and somebody smarter than me in some aspects said, "You know what, Rick? You're 80% of the way there, but the 20 is going to kill you."
The 20 is going to kill you. Yeah, that's famous last words in the mining business. Company that's not coming to your conference in Boca, Ramp Metals. The symbol is Ramp on the TSX Venture. Have you come across that one, Rick?
Until this moment, I was blissfully unaware of the existence of Ramp.
Oh man, Ramp Metals is not on your radar. Okay, it's in Saskatchewan. They drilled a great gold intercept last year. It's something you should take a look at, but we'll move on from there. Seabridge Gold. Now this one, you gotta explain this one to me. This has been around forever. It's had $1 billion+ market cap forever. Gold has risen $700 an ounce in 2025, and this stock is basically flat in 2025. What's with Seabridge?
First of all, I own it. So let's get conflicts out of the way. I own it again from the point of no concern which is to say, I owned the stock, got much more than a solid double, saw them needing to begin to spend real money on the early works, and sold enough that I had the rest for free. This is a superb optionality stock. But as they have to issue more shares to raise more money to do the early works so that they don't lose control of the deposit, the optionality gets less and less and less. This is a deposit, too, where the upfront capital costs are going to exceed the ability of mere mortals. So in the case of Seabridge, their future is not in their control. They are doing a wonderful job of managing the variables that they can control. They're spending $200 million on the ground doing the early works to preserve their interest in the deposit, which is one of the 3 or 4 biggest undeveloped assets on the planet. The bad news is that this deposit's in the middle of nowhere, and the upfront capital cost to build this thing, I think the last reasonable estimates we saw were $8 billion. That's probably $10 billion. What that means is that Seabridge is going to have to do a deal with a major multinational miner. Their future is not in their control. Could this take 4 years to take place? Could this take 5 years to take place? Yes or yes. Could it happen 3 months from now? The answer to that is yes. It is odd to me. By the way, I believe it's going to take place. It is odd to me that most speculators who I compete with would rather ask themselves an if question, which is to say, will this take place, than ask themselves a when question, which is, when will this take place? In the case of Seabridge, I believe I'm looking at a when question. In the case of most of the penny dreadfuls, you're asking yourself an if question. I've decided in my declining years, actually I decided in my early 30s, that I would prefer to ask myself questions where the answer began with when, not if. In Seabridge, because you have 100 million ounce plus gold deposit, you're talking about a when question. There are other really cool if questions with Seabridge, too. One question, a very pregnant question, is asked in conjunction with Pretium. About 40% of the Seabridge deposit used to be controlled by my friend Bob Quartermain. And everybody knew that if you had 100 million ounce or 120 million ounce deposit, that somewhere within that deposit, this vast low-grade sea of gold, that there would have been sufficient rock preparation that the fluids that caused this disseminated deposit could concentrate out and precipitate at much, much, much higher grades. Quartermain looked at his land package and saw that along the Brucejack Fault, and in particular along the Brucejack Fault where it was cross-faulted, that sufficient ground preparation had occurred that this precipitation yielded higher grades. And that realization and $100 million in exploration expense yielded a 7 million ounce high-grade deposit, which is in production today. I described this as an interesting question because there is no doubt in my mind that somewhere else in this land package, a similar circumstances occurs. You are between a rock and a hard spot with this, because if you are Seabridge, the exploration work that you do to find this starter package requires that you raise equity money, which lowers your percentage owner as a consequence of share dilution in the 120 to 150 million ounce master deposit. So it's a really interesting conundrum. It's a conundrum that will inure ultimately to the benefit of the major that does the deal with them.
When, not if. Yeah, that's a good point. Yeah, it seems that you almost would rather be in more of a permitting or feasibility stage project or company than one that's having to drill holes and make a new discovery. Obviously, the odds are higher, but usually the valuation is also higher. But there seems to be a sweet spot there.
I'm all about odds and probability.
Yeah.
I love early stage stuff. Love it. But I need probability. How does probability work? Well, I love the prospect generators. I love the people who have such high quality technical acumen that third-party mining companies give them money, not brokerage firms and individual investors. I love companies that give up some of the project upside in return for taking away all of the exploration downside. So I love project generators. The market hates them. The brokerage firm hates them because they don't have to issue shares. So there's no commission. So there's no research. The individual investors hate them because they won't lie to them. They won't get them really excited. But I love the arithmetic. I have now participated in probably 70 prospect generators in my life. I have participated in, I believe, 24 economic discoveries and 23 takeovers. If you think about 23 takeovers in 70 starts, what you're talking about is a success rate that exceeds 30%. If you compare that with the success rate in exploration in general, it is estimated that 1 in 3,000 anomalies becomes a mine. So I've enjoyed a 30% return in an industry where I should expect 1 in 3,000. So yes, you're right. I'm all about probabilities.
Do we have a little more of your time, or do you have a hard stop at 1, Rick?
I do have a hard stop at 1. I have to, we're doing a boot camp today, and
Okay.
I have to go pick up my producer at the ferry. I live fairly remotely.
Okay. Tell us about the Rule Symposium in 2 months in Boca Raton, Florida, please.
My favorite topic. This will be the 30th year of the conference. I can say really without hesitation that this is the finest value in natural resource conferences on the planet. Why is that? Well, the first thing is that we have great macro speakers, not failed journalists, by the way. We have, as an example, this year, David Stockman, who was the director of the Office of Management and Budget in the Reagan administration, talking about why cutting government spending never works. He isn't a failed journalist. He's from the belly of the beast. He's written a recent book called How You Actually Cut $2 trillion from the American Budget. We have Daniela DiMartino Booth talking about the Fed, again, not as a failed journalist, but rather as a former Fed analyst. We have Nomi Prinz talking about the structure of Wall Street, not as a failed journalist, but from the belly of the beast, a former Goldman Sachs partner. You get the picture. Our big picture thinkers tell us about the way the world is, not the way BNN or CNBC or CBS wants you to believe it is. Then we follow up with analysts and portfolio managers who have made money for people and themselves in natural resources for 40 years. Not somebody who failed at crypto, not somebody who's calling as big picture or macro, but rather portfolio managers who've made money in the trenches in natural resources and precious metals for 40 years. At every other investment conference on the planet, the qualification to be an exhibitor is a check that cashes. They regard exhibitors as advertisers. At my conference, the exhibitors are content too. Every single public company exhibitor at my conference is owned in accounts owned and managed by myself. There's no guarantee that because I own it, the share price goes up. There is a guarantee that I have vetted every single exhibitor. That guarantee exists at no other investment conference on the planet. For 30 years, we've hosted something called the Living Legends. The Living Legends are people like Bob Quartermain, people like Pierre Lassonde, people who have built multi-billion-dollar natural resource companies from scratch. This is important because they tell you how they did it. They tell you what mistakes they made. They tell you how the process made them better investors. They teach you how to find the $10 million company or $25 million company that's going to become a $5 billion company. All of that allows me to say to you, whether you attend live or via live stream, 3 things. The first is that we're going to give you 50 hours of programming in 4 days, more than you can possibly absorb. But we make recordings of the entire proceeding available to you for years, so you're going to need them. Secondly, for 5 months before the conference, I interview every single exhibitor and every single speaker. These are available so that you can prepare yourself before you get to the conference. You have 4 days. You can't possibly absorb everything, so you have to allocate your time. These pre-conference interviews allow you to allocate your time before you get to the conference. That's absolutely critical. After the conference, we host workshops. Well, we host a series of discussion groups in the Rule Classroom where you can compare your conference notes with 2,000 other attendees. 2,000 brains are better than one. This is the only investment conference in the world that never starts and never ends. It goes on and on and on and on and on. If you are a casual person, if you're a tourist, if you're the kind of person who buys the Sunday paper to read the crossword puzzles, don't come to the conference. This is hard work. But if you are a real person, I will tell you this. If you attend my conference, either live in Boca Raton or via live stream, last year people from 33 countries came, however you choose to attend, if for any reason you think that I didn't earn the money that I charge you to come to the conference, there is an absolute unequivocal money-back guarantee. There's no other conference in the world where you suffer no financial risk. If you don't believe for any reason whatsoever that I haven't delivered value, I'll give you your money back.
Money back guarantee. The Rule Symposium in Boca Raton at the Boca, resort is definitely one of the highlights of the year in terms of precious metals and mining investment conferences. I attend every year since, I believe, 2021, and I'll see you in Boca, Rick. Thank you for your time.
I look forward to it. And by the way, I prefer attending in Boca. There's a lot of non-verbal communication that takes place that makes the live event better than the recorded event.
Yeah.
If you can't come, you can't come.
Brave the heat in Boca. And, the hotel rooms aren't terribly expensive, and you could also stay off site too, right?
The hotel normally is $1,200 a night. I have negotiated them down to $340.
Yeah, it's a 5-star. It's a 5-star result. So, it's a 5-star resort. So $340 a night is not bad. Thanks, Rick. Thanks for tuning in. This will be on my YouTube, Goldfinger Capital. Cheers.
Thank you so much, sir. I appreciate it.
Thank you.
Bye-bye.